Okay, I can see it.
You do?
Yep.
Great. I'm just going to go in and change the title and all that stuff.
Oh, sorry.
Oh, I thought that was the.
Hello.
Mike.
Hi, everyone. How are you today?
Good.
Hi. Good, thank you. How about you?
Good.
Great. Hi, Mac.
Good afternoon. Hello. How are you?
Good, thank you.
Good. Hello, all.
Oh,
Mac.
Hi, Mac.
Hey, Mike. How are you?
Good, thanks.
Good. Hey, Dorothy.
Hi.
Let me get the right background here. What meeting I'm in?
We're all coordinated.
Yeah, right. Exactly. Let's see. Who are we waiting on? I know it's 4:30 already. But anyone missing?
I heard from Mary Kate Mac. She is in Vegas. It is full on for her out there. So I know she's not going to be able to join us.
Okay. Thanks. I appreciate that. Anyone else we're waiting for?
Maurice said he would attend, so Andrea's joining now.
Of course, you are the quorum of one. So if you
and then Maurice is the backup, so he's attending as well as.
Why don't we give him another minute and we can get started?
Sure. Thank you.
Since this is Jonathan, I'm quorum of one.
There's Maurice.
Excellent. Great. Good evening, Maurice. And why don't we get started? Call this meeting to order.
Okay,
And
so
do we need to take a roll?
yes, Max Starks,
Here.
Mary Kate, and Maurice Lindsay.
Here.
Thank you.
Great, thank you. Michael, take the floor.
Okay, good to see everyone. I will pull my screen up as usual. And let me just find the right window here. There it is. Can everyone see that okay?
Yes.
Okay. So good to see everyone. We'll walk through the report as normal. I would hopefully everyone had a chance to look at it. It's pretty good news. one of those easier quarters to have an investment committee meeting than most. So we'll take advantage of that, but we'll go through it efficiently as we usually do. And don't hesitate to interrupt me if there are any questions. One thing I did want to point out is this is the last step of the merger we talked about over the last year was we did change our name and do a rebranding. So going forward, we'll be known as Fiducian Advisors, which yes, it is a made-up word. That's how you pronounce it right here, and we were able to define it. So it's definitely a nod back to the legacy FIA days. We actually hired an outside advisory firm to do a bunch of industry surveys and whatnot, and Deneo Schneider just didn't kind of put forward what we did and who we worked with and how we sit on the same side of the table. So we made the decision to make the change and got a fancy new logo and some new modern materials. But other than that, and most importantly, none of the leadership or ownership or service or investment approach or anything changed. It's really just a name change. So hopefully that's the last time you'll have to hear from me about a firm update in the near future anyway. We'll start with the governance. This quarter is relatively quick. We did put some information here on spending trends because we don't take a set spending draw from the long-term or the short-term pool. I don't know that we need to spend a ton of time on that, but maybe just a couple interesting things. Generally, colleges that, in their traditional endowments have been reducing spending levels in an effort to and on a gradual basis in an effort to give them a greater probability of maintaining purchasing power into the future as return assumptions continue to tick down a little bit on a forward-looking basis. So you can see that trend on this sheet. And then just a couple interesting things about last year. About 18% of colleges reported making excess or special appropriations out of the endowment to fund certain projects. I'd say what jumped out at me was only 2% of those responding said it was to fund a short-term budget gap as a result of COVID. I would have thought that number would have been substantially higher than that. I think probably would have been, right, if there wasn't as much in terms of fiscal stimulus to help out with that scenario and maybe as quick as recovery as there was, but certainly still, as you all know, some work to do to get through this. And then lastly, most schools are kind of expecting to keep their spending rate unchanged going forward. So still leaning on that heavily to fund operations. On average, colleges, the endowment funds about 12% of their total operating budget. Certainly there's a big dispersion between some of the larger schools and smaller schools, but that just, we don't spend a ton of time on this, but just some interesting metrics around the broader education marketplace. And then lastly, we put the fee review front and center once a year. So this is always in the book, but we do it for the long-term pool, short-term pool, what you pay to Wells Fargo, and then what you pay to us. We actually added peer group fees in here as well for all the different categories. So you'll see in every circumstances, you would expect what you're paying versus what the median is you're well below that. And in some cases, meaningfully so. And it's something we're always trying to look to push the fees down as much as we can. One of the things we have some control over, right, in terms of driving excess returns. So if there's no questions on the governance, we can flip over to the markets.
Yep, no questions.
Okay. So first quarter was really another strong quarter for risk asset classes. Markets continued to be supported and really propped up by a tremendous amount of both monetary and fiscal stimulus. We outlined the American Rescue Plan Act here and just where all that capital is going on the upper right-hand side. Kind of take those very pointed stimulus efforts, not just here, but globally, overlay some positive trends, obviously, with where the vaccine is headed and some initial economic prints that are recovering and kind of in line with where folks thought we would be from, GDP expectations for 21 and 22. And that really has continued to be a nice foundation and starting point for equity markets in particular, but really all risk asset classes, and has been very supportive. And we think it'll continue to be supportive, at least here in the short term. One of the interesting things about all this stimulus is when we had all this monetary stimulus in the financial crisis, a lot of it never left the banks. It was more to shore up their balance sheets and encourage lending, but none of that really happened. It really never got onto Main Street or into individuals' pockets. This time around, a lot of it is focused on Main Street, and a lot of it's getting to small businesses and consumers. So we've seen consumer demand, consumer spending levels increase dramatically. And again, strap that on top of pretty strong growth expectations from the risk asset classes. And we've seen inflation expectations move up pretty quickly here through the first part of this year. This chart is looking at the break-even inflation rate, which is basically the market's expectation for inflation. And it's really the difference between what you get paid to own a nominal treasury security and a similar duration treasury inflation protected security. So the only difference you're supposed to get in return is the inflation. So that's really a kind of a good indicator of what the market's predicting. You can see that in both those circumstances has moved north of kind of the quote unquote Fed target of 2%. We haven't seen CPI creep up there quite yet because this is forward looking, but something to pay attention to. That also means that alongside rising inflation expectations typically comes rising in interest rates, right? Because it's at one point, if in order to buy someone or to issue debt to someone, you're going to want to get paid a positive real return for taking on that risk and loaning them your money. So if as inflation goes up, generally that means new issuance, the interest rates are going up there as well, which we've seen, which had a negative price impact on fixed income for the quarter. The other big trend was a pretty major reversal in market leadership. So we've been talking for quite some time with this committee and really with all the groups we work with that it's been a growth-driven rally in the equity markets, driven by a handful of large technology names here in the US. We started to see that subside in the fourth quarter, and it really accelerated in the first quarter. So value came back into favor, particularly some of the most beaten up areas of the market, some of the consumer cyclicals. Value was really the place to be in the first quarter. And again, really year to date, even through the last couple of weeks. And the portfolios have really benefited from that. We've had that modest value tilt on the portfolio, which had been a headwind, and has stayed patient with that. And you'll see that we were pretty nicely rewarded for that as a result. Couple things to look at from the capital markets. So pretty remarkable turnaround in 1 year. Right, when we were having this call last year, it was a very different conversation. You roll off a really crummy first quarter of 2020, and you look at these equity returns, the S&P up 56%, the Russell 2000 up 94%, international markets up 45 and 60% respectively. So pretty dramatic returns from the equity markets. Positive results from the risk sectors of the fixed income markets as well, but we actually have seen negative returns and really flat returns from core fixed income and treasuries as a result of the volatility in rates. So the ag on a 1 year basis was only up 70 basis points. And actually for this quarter, it was down over 3.5%. And that was driven by that shift in the yield curve. So we started the year with a 10-year about 90 basis points. We ended it at 174. So it's a pretty dramatic shift on a relative basis. This is still not overly exciting from a yield perspective, right? Based on history and what they're paying you to take out government debt for 10 years. It's still a negative real return, but a pretty dramatic shift up from where we started the year and certainly where we were last summer when it was closer to 55 or 60 basis points. So that was really the big driver of the negative returns in fixed income. Spreads have also continued to move in as well and pretty quickly back below 10-year historical averages now. And you're certainly not being compensated like you were in the summertime to take added risk in the fixed income allocation. So we still think it's prudent to do so thoughtfully and get that incremental yield, but it's certainly not as attractive as it was this time last year. And on the equity side, something we're paying attention to, I mentioned that we think equity markets will continue to be supported by all the stimulus efforts and positive news and vaccine news that's out there, but you can't kind of disregard where valuations have moved to. We're looking at CAPE ratios here, and actually that's pretty dramatic how pointed this is. So again, median is this light blue bar. One standard deviation is where the dark blue bar ends, and here's where the gray, we're at this gray bubble right now. So north of 2 standard deviations overvalued based on long-term historical averages. So at some point, valuations will start to matter, and we kind of need to think about the implications of that for an endowment pool. We don't want to make a huge bet on this, but we also want to recognize that we don't want the outcome of these returns totally dependent on what U.S. equity markets do, which is one of the reasons we're so diversified, and we've touched on that in the past. Any questions on the capital markets before we overlay that in the portfolios?
And for me,
Okay, so we gave you the written commentary here. I obviously won't read that, but to end March, the total pool of assets was about 18.4 million, about 13.5 in the long term, and about 4.9 in the short term. So I've seen some nice asset growth there, particularly in the long term side. Digging into long term, you'll see the allocation here. We did update the target on the fixed income side, as we touched on last meeting, to set that toward the 25% mark. So we're basically right on line with these changes. Two things we did right at the end of the quarter, which aren't reflected here because the trades happened in April, but you'll see them in the next report, is Diamond Hill, which is one of the ways we've been getting that value exposure, has had a phenomenal run. Not only are they value that they benefited from, but they have been the top performing value manager. So we took that as an opportunity to know that those types of things don't happen forever. And we did lock in some gains there. So we actually took this Diamond Hill allocation and cut it in half and redeployed it across the domestic equity allocation. The other thing we did was eliminate this dedicated international small cap exposure, as the active managers are beginning to add small cap exposure to their portfolios. So we wanted to make sure we were more on market weight. We had to do that ourselves historically, but as the opportunity set has shifted, there's really no need to have that exposure. So we eliminated the Templeton fund and redeployed it across the international allocation as well. So you'll see that reflected in the in the April flash report.
hey, Mike,
So
Mike, I don't recall, but were there any funds on the fence with us, and now things have turned around given the market, the way the markets have performed over the last year?
I mean, yeah, if we were looking at the Diamond Hill fund, which I'll show you here in a minute, a year ago, you would have said, why do we own that?
Right.
And now you'll say, well, it's a good thing we owned it. So
Right.
we'll take a little bit of credit from that, but a lot of it's just a great market tailwind. But no, the only manager we have on watch right now is Atos. That's one that I wouldn't be surprised if we move to a different mandate at some point in the future. It's not a huge issue with them. We just think we have a couple names we have a higher conviction in going forward. But other than that, everyone has performed quite well, and staying patient with some of the ones that have struggled a little bit, we've been rewarded for.
Okay.
So here's the fun part of these meetings. So here's the return. So for the quarter, the portfolio up 3.8% net of all fees versus 2.4 for its benchmark. And on a 1 year basis, up 40% versus a benchmark of 33.9. So just, stunning returns on an absolute level, and then very strong on a relative level. And that's pretty much eliminated all of the a little bit of the drag that we have because of that value overweight the last couple of years. So it happened pretty quickly, and it's not done. It's impossible to know if the value run is done yet, but on a relative valuation basis, there's still a long way to go to get growth and value styles back in line with their long-term historical averages. So again, we think having a little bit of a value tilt continues to make sense, which you'll see here in a minute. So super strong returns and really broad-based. So I mentioned on the fixed income side, you can see for the quarter, the ag was down 3.4. The portfolio was down, but not nearly as much, down 2%. So we did get some meaningful protection from some of those dynamic and diversified mandates that we've had in here. You can see BlackRock, which we want to generate a positive absolute return regardless of what interest rates are doing, did just that. So right where we'd expect them to be. And then again, on this 1 year basis, being tilted towards spread and away from treasuries and being more dynamic and diversified really paid off. See BlackRock up 14% versus the ag of 70 basis points. The core manager up 3.7 versus 70 basis points. And then the global exposure, which is emerging market debt and currency, up almost 22%. So all the fixed income managers really performing where we'd expect them to be. And kind of totally moving, offsetting what had been a challenging environment for them when we talked this time last year when interest rates had declined so dramatically. On the domestic equity side, up 8.4 for the quarter. So in a strong value quarter, a value tilt really helped versus 6.3 and up 65.8 on a 1 year versus 62.5. Here's that Diamond Hill mandate I talked about. So value was up 58.4%. Diamond Hill was up over 100% on a trailing 1 year basis. So again, that's great stock selection and some nice tailwinds for them, but those are the types of things that you don't expect to see or at least be consistent, right? So that's why we did trim them back partially in the portfolio, but they were a big driver. And then Boston Partners up 96.7, right in line with their benchmark on the small cap side, doing a nice job as well. On the international side, a similar story. Extra returns were even a little bit better on a relative basis, 4.1 for the quarter and 56% for the year. Again, broad-based. The one manager that took a little bit of a pause was MFS. So they had really been carrying the torch as they're tilted toward the growth side over the last couple of years. They looked weaker relative to their core benchmark in a period where value came back, but you can see they've still been a primary driver of portfolio returns and really nothing we're concerned about. And then Dodge & Cox on the value side, up 57.4 versus 48 for the benchmark. That value manager, another one, Mac, that hadn't looked so good, but really kind of came back into fruition as that started to flop over. And then Schroeder's on the EM side has continued to be a very consistent performer for the portfolio. So really strong there. And then on the alternative side here, the story's been good as well. As we've started to see inflation expectations pick up, we've seen real assets respond, which we'd expect them to do. And in the principal fund where we get that exposure, had a nice relative quarter. Cohen & Steers, which was a manager we added midway through the year to replace Morgan Stanley, which had really been struggling. That has been a good decision. They've outperformed and have outperformed Morgan Stanley. So I wish we would have done that a little bit sooner, but happy that we made the move. And so that's been positive. And then the Atos fund, the one that we have on watch, right in line with its kind of the peer group, longer term on a 1 year basis, a little bit behind. Remember here that this is a peer group of different hedge fund of funds. So you have some that are more aggressive than Atos and some that are more conservative. They tend to be more on the conservative side. So we'd expect them to plot a little bit behind median in a very strong market environment because they don't have as much equity risk in their portfolio. But one of the reasons we own them, right, is to dampen portfolio volatility, but take that roll away from fixed income in this really low interest rate environment. So in a year, right, where this fixed income portfolio did great, it was up 8.9%. If you own just passive fixed income, you're up 70 basis points, moving the allocation to the hedge fund side of things up 20%, added meaningful value on a bigger picture scale as well. So again, really not a lot of negative things to say for this quarter, which is nice every once in a while, but I'm happy to pause there and take any questions. And the one thing I would say, and we're not kind of just sitting on our hands as a result of this, right? It's great to see these types of returns. These type of returns obviously aren't sustainable longer term, and we always need to be thinking about what's to come. So always making those proactive changes in the portfolio, rather than just kind of writing what has worked of late. So that is an ongoing project.
Mike, thanks for that. That's one of the things that I appreciate the most. I continually get the sense of management of our account, which is certainly something that we want. And while things don't always go our way, at least we took action where we thought appropriate. So to your point earlier, and throughout this conversation, I mean, it was an easy kind of flip through as I went through the deck, prior to the meeting. But I had that one question about managers, because I know that we had a couple of managers or funds, I should say, that we were looking at. But when you look at the deck, today, I mean, the returns are so strong. It's tough to have any questions. But I guess looking forward, is there anything that is on the horizon? You mentioned a couple that you might want to swap out, like Atos. You're looking at that. Anything besides Atos that is kind of bubbling?
I don't think so. I think at some point, Mac, I mean, at some point we will pull off the value tilt. I don't know when that's going to be. I wouldn't be surprised if it was sometime this calendar year, particularly if we start to see that trend kind of move in that direction. That is something that we'll, be proactively looking at. Thinking about the amount of spread exposure and the fixed income allocation. That has been very beneficial. Again, you're still getting a benefit from taking a little bit more risk, particularly if you have a good manager who's being very thoughtful about it. But if we get to points where it doesn't make sense anymore, or we see rates start to increase, where it's now we're getting paid, if we ever got to a place where we're getting paid 2.5%, 3% to own core fixed income again, we probably would look to de-risk the portfolio and kind of take advantage of that. But I don't think we're quite there yet. So I don't imagine there being any dramatic shifts in the portfolio over the next quarter or so, but certainly always evaluating the construct of the fixed income allocation and when the appropriate time to take the value tilt off is to an extent. And then always paying attention to managers. Even if we don't have a manager that moves to a watch status or a terminate status, but we have higher conviction in someone, or we think they play an interesting role in the portfolio, we'll proactively make those changes. We don't have to have someone on watch or terminate to move away from them if we want a different type of mandate or philosophy or approach. So I'd say those are probably the three big things that we're looking at. But from a kind of a strategic allocation and longer term view, I think the portfolio continues to be in a good place.
Thank you.
Just a couple of comments, I guess. Mike, as always, I think over the 5 years I've been here, this is such a source of confidence, right? Our relationship with Fiducian and FIA before that, it's always really helpful to see the landscape and to know how solid we have been for as long as we've been. In these times where there's just uncertainty around every other corner, these are meetings that I know we look forward to because there's a sturdiness there. I say that because it was really helpful to have your benchmarking on the front end to see other colleges and what percent use this version, our quasi-endowment, right, to help with their operations, and to know we've been able to avoid that practice. We've used it as an insurance policy, certainly work with trustees for sort of one-time things. And with the federal money that we have now, we'll be able to look to that as a first source, I think, for the future. Again, I just looking down the road, with Andrea Nathanson already sort of trying to forecast a little bit. We've got some capital projects we're always talking about, right? The idea of post-federal dollars. What does that all look like? I imagine we'll continue that, but it's just so nice to know kind of hands we're in with all this. So really, really appreciate that.
I appreciate those comments. The last thing I'll do quickly is just give you the overview of the shorter term pool. So again, we ended March about 4.9 million, essentially right in line with the target allocations. Here was actually a negative return as a result of being predominantly, or like actually all fixed income in a rising interest rate environment. But again, on a 1 year basis, right, the goal of this pool is to do better than what you can do in money market, and certainly 2.4% over the last year was achieving that. So it continues to be pretty consistent, and looking at the managers, there's really no issues with any of the managers. Everyone kind of plotting right in line with where we'd expect them to be. So really no changes to this pool. I think doing what it was intended to do.
Yep, looks good.
So that was everything, Mac, that I had prepared. But obviously, if there's any questions or thoughts or any requests from us for our next meeting or ad hoc, we're happy to address them or talk through them.
No, I mean, I'm good. Like you said, but given the returns for this quarter, it's I didn't have any questions, and other than, like I said, the ones I've asked so far, I think that the focus each quarter that you laid out at the beginning, is good. I kind of like that. I like the way you walk through, as Michael said, as John said, I like the way you walk through the details, with us. And while we have an hour booked, there's no need to fill up the hour, and we don't need it. I think unless someone does other questions, I think from my perspective, it's been a great, like you said, the market has been good. but the management of our account is what I'm always most interested in. And again, that seems to still be there, regardless of what you call yourself, today. But at the end of the day, we're still getting the same great service. So I appreciate it very much, as John echoed. Great. Any other questions of Mike? Okay, great. I guess with that, we can take the roll to adjourn the meeting.
Yes, Max Starks,
Yes.
Mary Kate Mirren, and Maurice Lindsay.
Yes.
Thank you.
Great. Thank you so much, Renee, and
Thanks,
everyone have a
Take care.
great
Thanks,
evening.
everybody.
Thanks
Take
so
care.
much. Thanks, Michael. All right, bye.